All right, thanks everyone. So I'll just spend about 6-7 minutes kind of giving a quick background on Experian Ventures, mostly through the lens of what I've been through. So as was mentioned earlier, I've been in corporate venture pretty much my entire career. And so there's some learnings along the way that I've tried to take from one organization to the next and apply it, because in certain situations, obviously within a corporate venture environment, a lot of the things just don't simply work within one environment versus the other. So I'll try to share with that as much as I can. So we'll go through a couple slides here. Let's see. Okay. Now, from Experian's perspective, historically, if you guys know, it's a publicly traded entity on the London Exchange. They've been much more acquisitive than making minority equity investments. I think if you look at the history of Experian, they made about 80 or so acquisitions over the past 10 years, plus or minus. And so making venture minority equity investments was just not something that was in their bailiwick, if you will, not something they had practiced, not something they had thought about, not something they had sort of included in their annual strategic planning process. And so a little background on the company, as I mentioned, Experian Ventures was created in September 2016. When I joined, I was recruited in to build the program from scratch. And much like most of the corporate VCs out there today, the mandate is sort of dual in nature. One is to generate financial return, and I would say that has to be part and parcel to a strategic return, because if you're just going to lose money, there's no point in actually having a venture group, because that's just called an expense. You might as well build something that actually can generate value beyond the investment itself, and that would be measured through financial return. All right, so a little bit about myself. We highlighted why it's relevant only because I come from Intel Capital, where I spent 15 years, about 12 years actually on the venture side. What's relevant there is the fact that Intel Capital has historically been sort of viewed as the gold standard, if you will, from a corporate venturing perspective. So there's a lot of key learnings I take from that. I was also at USAA as well and helped build out their corporate venture program from a very small shop, 2 to 3 people, to where we were doing about 7 or 8 deals the first year that I was there. And then the comment earlier about being a founder, yeah, that's a stretch. I did co-found AppScotch, which we subsequently sold to App Annie a couple of years later. But there is some benefit, I think, of being on the other side of the table, and that being, you learn how to judge, entrepreneurs when you do an investment, but being on the opposite side of the table and, being judged by VCs is kind of a different challenge, and understanding how difficult it is for a startup, right, to go and land that first round of financing. So some accomplishments. As I mentioned, the group is fairly early. We started about 2 years ago. The first couple months, if you will, you can imagine coming into a new organization that's never done venture, was explaining to them how venture worked. So we spent about 4 or 5 months just building out a process with a formal policy and procedure, as we call it, that was then signed off by all executive management, et cetera. And this is how we're going to run the deal process with the various checkpoints. Here's the thresholds. Here's when we take board seats, why we take board seats, why we don't take board seats. Here's how follow-ons work, et cetera, and stuff like that. And over that course, it was just me. I brought on somebody in North America about 8 months ago. We now have someone in Singapore, someone in Brazil. I'm in the process of hiring someone in London. But with all that behind us, we kind of closed 4 deals in the first 12 months, and then 7 deals in 2018. Knock on that, could be 9, but it just depends on when that we can close before end of the holiday coming around. So it's off to a good start. Whether that's a good or a bad, it was hard to say. I think we were trying to do roughly 4 to 6 deals per year, and then being able to do probably 6 to 10, 6 to 12 on an annual basis going forward with more broader reach. But part of that, being in the venture space is trying to figure out what the value add and where we sit in the value chain relative to our partners who we want to look to invest in. And one of the challenges we come across was, generally early stage companies, seed stage companies, find it very difficult to work with Experian, right? Because traditionally our business model has been, we will sell them data and or services. Now, if you're a seed-backed company who's raised maybe $500,000 in capital, it's quite hard to say you're going to part with $50,000 or $100,000 worth of your minimum your balance sheet in order to buy data and services from us. So the way I solved that problem in order to work with the early stage seed companies was create something called the Data for Equity program. So the thesis there is that rather than shun early stage seed-backed companies, I would give them data as much as they need up to a certain point so they can build their sort of POC or MVPs, if you will, to get to market. And the thesis being very simple. I want to remove the paywall for all the startups out there, early stage, to work with our data, give it to them for free, get their products developed. Because the way I look at it is the way, if you will, of doing outsourced innovation. So I give them the data. Hundreds of companies can build on it. Probably a lot more that we could do internally. So I'm leveraging the venture community to do that by enabling the startups to do with my data, my services. And if it all works out, obviously the equity part is tied into it, where we get a warrant in the company. It goes well, we can always invest in follow-on rounds later, et cetera, et cetera. But this has actually been very well received. We're doing a launch in North America now, launching this week in Brazil, and we'll look to roll it out in other geos as well. The corporate success, let's go through it quickly. I'm kind of in a time crunch here. So some of the things that you notice in the corporate venturing program is all this bureaucratic process. Everyone has to see it and sign off on it, and all this process-related stuff on the corporate side. Some things I would throw out there for everybody to think about if you're getting into the corporate venture program. Try to keep it as simple as you can, right? It has to be very robust, very agile, the ability to get deals through a process and a pipeline very quickly, in sync, if you will, with the traditional venture cycle, which is every Tuesday, if you want a partner meeting. Unfortunately for us, our meetings effectively run every 2 weeks to every month, and so that kind of throws a lot of cycles, a lot of people out of cycle, if you will. We're trying to get deals approved. Due diligence checklists. I joke about this with a lot of folks that have asked for my advice on this. When I came into Experian, we started with a due diligence checklist that was born out of the corporate M&A team. And if you can imagine what that due diligence checklist looked like, it was about 680 lines, 680 too many, so I cut it down to about 60. And it's a very straightforward due diligence checklist to get through the process fairly quickly. And minimally on the investment bucket side, we don't invest in everything, but we try to keep it broad enough so we don't sort of shy away or dissuade anyone from bringing deals to us. But macro speaking, right, you can imagine where we play, which is in the broader fintech or financial services ecosystem. Certainly within our environment, partnering and tag teaming with the business unit is important. There's always generally a desire to have a partnership or some sort of collaboration opportunity with the business unit. So partnering with those folks from a process and approval process perspective is very helpful, getting them on board. And the second bullet here, then I'll kind of skip to the next slide, is when you go to talk to startups, right, you're trying to differentiate the value you bring to the table, right? Because I would start by opening and saying that every dollar is a commodity, right? So you got to be able to differentiate your value to the startup. And for Experian, it's pretty straightforward. One of the largest bureaus, if you will, collectively, almost 1 billion records under management, distribution across thousands of FIs. This is something we can differentiate relative to others, and so we play that up as much as we can as to why we would be a good partner / co-investor. Now, some missteps along the way. I guess it's fairly easy to say the first one, which is I assumed everyone knew how ventures worked. The reality is, not everyone, you're laughing, not everyone realizes that the process is quite different than the M&A process, and I was probably biased by the fact that I had a team internally that was more skewed towards historical M&A. So yeah, don't underestimate that. And the bureaucracy side of it, as I mentioned, we have an investment committee, which I asked for a very straightforward investment committee, as well as tiered approvals by dollar amount from 2 million or so and 3 million, et cetera. And what I ended up getting, which is for different reasons, was the CEO, the CFO, and the COO, which, for a $500,000 investment, you would think that's quite a bit of C-suite time to approve a deal. But the reality is they also like to see the pipeline of transactions that we're looking at. So I think what you end up finding is over time, as the portfolio builds up and we do more and more deals, they get a lot more comfortable with the types of transactions we're doing, and I'm sure that the threshold will change. All right, future state, and then I think we'll move on to Q&A. As I probably alluded to earlier, trying to get deals through the pipeline faster, and that's partly just to be on cadence with traditional venture cycle. If you can get into a company, get into a transaction, if you can really get it done in 30 days or less, it's ideal. That doesn't always work with corporate cycles. Sometimes you get stuck with an investment committee that doesn't meet for a month, takes the Christmas holidays off, et cetera. So trying to get deals done faster is something we're shooting for. And then trying to get the organization to think about not just the revenue potential with the commercial in an investment, but how that investment will put us into a different mindset and different thinking on the larger strat plan. Many of the deals that we've done today, especially outside the US, have been on the back of a commercial deal. So the investment committee is very happy because we're getting a commercial deal with a company that's generating revenue and it's benefiting Experian, which is great, but where does that take us in terms of next generation of scoring services, next generation of direct-to-consumer models for fintech applications? So that's where we're trying to get into that process, and it's on an annual cadence. We go through strat planning. We're starting to see that change because a historical strat plan has gone from just identifying M&A targets to identifying M&A targets and partners that we can invest in. I think that's it. Okay?
Yeah.
All right, thank you.
Alex. Thanks. Great job, particularly since I had to rush you a little bit. My apologies. But I think we still have some time to get you to answer some questions that, again, amplify some of the points you made. One of the things I wanted to ask you was, you have this data for equity program, and obviously there's a good deal of value added to the, very attractive to the entrepreneur, and you're monetizing a valuable asset. What else do you, when you pitch to them, what else do you say you provide them, advise, other kinds of benefits that they wouldn't otherwise get?
Yeah, most of that will come in the form of, when we're talking about financial services, our connections into the financial institutions. And that's one of the biggest things that we bring to the table, right? Because if you think of all the banks and financial institutions that are leveraging Experian in some form or fashion, whether or not it's from a bureau perspective or our digital onboarding tools or our decision analytics, that's probably the one that gets them the most excited, and especially in emerging markets. We've done a number of transactions in Southeast Asia recently. We just announced the deal yesterday, where that gets them the most excited because there's an element of Experian's brand and reputation that everybody knows about, but also the fact that we have this best-in-class, best-in-breed, if you will, analytics engine, that gets them the most excited. And then they find out, yeah, by the way, we're also looking to invest behind it, so we're putting some muscle behind that relationship, that gets them duly excited.
What kind of relationships do you have with VCs? Do you find that at all important?
Oh yeah, absolutely. So a bit of advice I'd give to anyone who's looking to build their own venture group is, never go it alone, in the sense that always look for traditional VCs that are there to make money. I mean, that's a good sounding board. That if it's only a bunch of corporates in the company, that generally means there's not been a financial mindset or lens to the viability of the business model, right? I mean, that goes back to the days of pre-2000, for those who are old enough to recognize what the bubble looked like in 2000 days, where you had 1,000+ corporate VCs, and they would throw money into startups, and if there was way too many corporate VCs, it generally was an indication that the financial VCs didn't believe it was a financially viable investment.
When you deal with the VCs, how do you get them to work with you, and versus saying, "Oh, these corporate guys, it's just dumb money. There's really not much."
Are you channeling Fred Wilson or what?
Of course, he's an old friend. No, I mean, this is something that is, it's become a bit of a cliche question, but because you're working with VCs, I know when IBM, for example, changed its model of corporate venturing capital to basically a similar approach where they would offer services and help the startups, when they approached VCs at first, it was a tough time for them to get the support of the VCs. Did you find that as well when you started to talk with VCs?
Well, I think it's I've been in venture since 2000, right? So I've been around long enough, and I would say that if you look at the history, you have to go back and think about the history of venture and corporate venture role. Corporates were undeniably the dumb money, and I was part of that, if you will, back in the early 2000 timeframe. I think they've gotten a lot smarter in terms of the value add you can bring to the table. I would throw back at Fred or anybody who would say that you could not paint with a broad brush that all corporates are dumb money. I mean,
of course.
You're painting Intel Capital, you're painting Google, you're painting a bunch of them. I mean, I would argue that their returns alone in the financial side probably outpaced 90+% of the VCs out there. So for us on the Experian side, it was just trying to figure out what is the value add that we bring that's different than what they can bring. So you may have great entrepreneurs that can help you that are now VCs and giving you money. They can help you build the organization. I think obviously you need that. For a first-time entrepreneur, you need that support group around you, or former entrepreneurs who are VCs. But there's at times where they won't have the breadth of connections. So we have this breadth of connections within Experian across the globe with all these financial institutions. We can definitely bring that to bear. Whether or not we need to invest, well, the logic there is very simple. If we're going to be partnering with you and we help make you successful, why would we not participate in the upside? So do you need to invest, to Fred's comment about invest or just acquire? If we're going to help build successful companies and they're going to be built on the back of us, why would we not participate in the upside? So that would be my counter argument to that. Yeah. The biggest challenge is can you bring value at the board level? Can you bring value as a board director, board observer? Can you bring connections that will help the company? Not bureaucracy or non-participatory board participation, because that's probably the most frustrating piece, right? You have this money that's come into your cap table, sitting on your board, but the board member never says a word during a meeting. So that's kind of the worst scenario. Yeah, you get the great money, but they're not adding value beyond the dollar.
Do you think that a lot of the value that you brought, in fact, to Experian in terms of corporate venturing was, the ability, the insights that you had both, with Intel that you developed, the work that you did in terms of developing this kind of credibility and again, working with the important parts of the ecosystem? Was that and this was kind of a new challenge for you, because you were going into you mentioned before, this was an acquisition-oriented culture.
Yeah.
How did you convince them, in fact, that, okay, you guys have been doing acquisitions, but sorry, that dog don't hunt anymore?
Yeah, the hard part of getting the management and the board to sign off on a group was not done by me. So they had thought about this for quite some time. So I didn't actually have to go through the hard part. I got recruited as someone who actually could build it. And so that was, I guess that was easy in that regard, but that being said, I kind of highlighted some of the things that you kind of come across where I made way too many assumptions on what they knew and didn't know about how venture programs work in terms of the process, the ability to get deals through a pipeline fairly quickly, the ability to react and respond very quickly in terms of a timeline of closing a transaction, sort of the expectations, the ins and outs of term sheets and what we got to be mindful of. You got to be very, explaining to them the difference between traditional venture, which is LP-based, singularly focused on financial return. Strategics have a different mindset, right? Because it's not just financial return. It has to be this combination of strategic and financial return. And I've been, pretty violently opposed to anyone just trying to set up take corporate money, put it into a fund, and go invest. Because I think if the objective is for a corporate to generate financial return, that's very easy. Just go become an LP in the top 10 performing funds in a category that you want, because that's how you generate financial return. So you have to think about how to get the strategic value, quote unquote. Obviously, it's qualitative, not quantitative, but being able to get the folks internally then to understand this is how I leverage it, right? To your point earlier about historically, Experian is an acquisition-oriented company. They think about acquisitions because, like most, you think about growing the P&L, improving the EBIT, getting into market segments. You don't think about how to invest in companies to gain value independent of that, right? Because we're not targeting greater than 20% ownership. We're not looking at consolidation, et cetera. So you're taking people's time away from targeting acquisitions that would help them build their P&L to supporting investments that gets them, quote unquote, insight, if you will, and maybe strengthens partnerships. And it does vary. Like in the US, what we get out of venture deals is definitely quantitatively different than what I'm getting in value out of deals in APAC at the moment.
Let's move on to questions regarding compensation, regarding the questions of how the structure that you set up, measurement issues, all those different kinds of. Now, these are sort of among the top questions that people have when they're setting up a corporate venturing fund are related to these questions, right? So, how would you summarize the key things that you learned, or the key things that you would advise others about those?
Compensation questions on stage, yeah.
In general, obviously, we won't get into any details here.
So I think you're taking a corporate environment and you're trying to apply to it an industry that has this 2 and 20 model, right? I think there's aspects of the motivation in the 2 and 20 model that should be embodied in the corporate VC compensation. Case in point, I think you can't give a corporate CVC, which is on balance sheet as opposed to separate and single LP, you cannot give them a traditional 2 and 20 model, because there's just no way if I were, for example, to have done the Uber deal or Google back of the day and suddenly generated billions of dollars of return, a couple $100 million coming to me versus a couple $100 million going to the CEO of Intel, for example, isn't going to happen, right? So the way I think you have to structure stuff like that, and I also think you shouldn't do it on a cash-based bonus. I think you should do it in stock options. So I think you should incentivize the team because you want them hunting and have that sort of that fire in their belly, if they will, to go hunt for good deals and be rewarded on the upside. But I don't think you pay them in cash compensation exclusively. I think you tie it back into stock options. So go ahead and give them, if there's a big payout, give them $5-10 million in stock, but make them earn it out over 4 years, year by year, because the whole point there is retention, and you want them retained, and you want them driven by the appreciation in the underlying stock price, right? To my point, I have made it here, but I've made it several times in the past. If you think about the returns of any corporate today, any corporate VC today, there's not a single shareholder that I could think of that owns Google or Intel or any of these publicly traded stocks with corporate venture groups that owns the stock because of the performance of the venture group. Okay, they own the stock for the performance of the underlying business. And so your upside should be tied with the performance of that stock, and so therefore tie their compensation to the stock.
Very good. In the time we have left, could you speak a little bit about the performance measurement issues you encountered and your views on the best way of handling that, perhaps, or sort of what were some of the, if you will, political obstacles that you encountered that you had to deal with?
Yeah, so we try to put in place a both strategic sort of qualitative and a quantitative metric for success. So on the metric quantitative side, obviously it's number of deals done and then sort of gross IRR as best we can relative to traditional, I'm gonna say vintage, but venture returns, right, as best we can. And the argument there is that we should be at least somewhere in top quartile, plus or minus, in terms of those returns. Now, that's a very soft calculation because there's a lot of stuff that drives that, right? We just can't go do an investment randomly because we think it's a great investment. We have to do all these alignment of stars and strategic interests and what have you, and there may be all these hurdles to go through. So I always try to draw an asterisk to that. So we do drive it qualitatively, we do drive it quantitatively, and then we also try to look at it qualitatively as how our venture investments are making their way back into the annual strategic planning process. How is the business, both globally, regionally, as well as lines of business, how are they thinking about taking venture as part of their strat plan? So that's the qualitative metric to it.
Great. Thank you very much.
Thank you.
Thank you for your insights.
Thank you.
Okay.